last week I mentioned here in Montana how cold it was going to be this week. Well, it happened. It got that cold. I said minus 27. That's about what it got to. There are parts of Montana that actually got to minus 35 to minus 40. I can tell you minus 27 is very, very cold. And so you just have to do things differently. You have to, deal with that cold, and sometimes things break at that temperature, and you have to deal with that. So it's just part of the travails of Montana, but it also, this is a beautiful place, so it's a little bit mixed. Now, over my shoulder, you may see a pen. That pen is a dog pen. So I got a dog. I'm going to show you a picture. But he's 8 weeks old. He's about this big. He is Great Pyrenees, a blend of Great Pyrenees and Anatolian Shepherd, which is a great mix. He looks like his mom, which is the Great Pyrenees, and 7 of them look like their dad, which is the Anatolian. But anyway, it's too cold outside, so I can't put him outside, and I don't have a big house. So it's big enough, but it's not too big. So in here, which is the entryway, that's where I've got the dog pen so that he can stay warm. And so, of course, he has to go out and do his breaks and everything, but absolutely a wonderful dog. And if you're a dog lover, you'd appreciate him. He just loves to cuddle and be petted and loves the affection. Not all dogs do, but he does. And so that's that. Now at the end, I'm going to show you a picture from my front porch of what I'm looking at. And you can see how beautiful it is here. So yeah, there's a bunch of snow and it's real cold, but there's a benefit. Okay, my name is Ben Reppond. Welcome to my YouTube broadcast. Today is January 16, 2024. Now, the things I'm going to cover today are this idea of debt, personal debt, of how much this is choking people in our country. And it's not just in our country, it's in other countries. So I know that Canada and Asia, Australia, Europe, they're just a mess. And real estate is literally in some countries, literally collapsing. And it's collapsing around people and causing them to basically kind of go under. I think the world financially, before you even get to the stock market, I think the world of personal finance is terrible. And we've got our own version of it, but it's everywhere. So I'm going to cover that. Last week, Bitcoin went public with some new ETFs. They didn't go public. They came out with some new ETFs, and one of the sponsors is BlackRock, and I'll talk about that. And then interest rates coming down, and what all that means, and that I'm hearing that more and more multiple drops in interest rates from the Fed. And if the Fed does that, that usually translates over into personal interest rates and mortgages and so forth. And then finally, I'm going to cover something on the housing market. So I've got a lot of subjects here. So stand by, we'll get into it. So the first thing I want to show is that this clip that a lot of people are struggling with debt, credit card debt or mortgages or rent, whatever. And the article, the video caught my attention because it said that over 50% of Americans have less than $1,000 in the bank and are living paycheck to paycheck. And, there were many years ago, I guess I would have been in that category getting started. But over 50%, wow. Credit card debt is now over $1 trillion in the United States. Interest rates are minimum around 20% to an average rate of about 24%. So let's just take somewhere in the middle, at 22%. That's about 2% a month. That is choking. So if people have tens of thousands of dollars of credit card debt and you start talking 20 to 24% interest, I think it's just a matter of just people just going so far backwards that no matter what they pay, they're going backwards because of interest. Student loan debt. Student loan debt is 1.7 trillion. 1.7 trillion. And it wasn't long ago when it was 1.3, I remember, and then 1 trillion. So it's now gone up 700 billion in not a long period of time. So young people are piling on debt on top of debt, and many, not all, but many are not able to repay it. People are graduating from colleges and getting jobs as receptionists or baristas or whatever, not high-paying jobs, and they're sitting on huge debt, tens of thousands, maybe even over 100,000 of debt, student loan debt, and no way to pay it back. So I don't know what the end game is on this, but as I look at the picture, you say, as an economy, and other economies are worse than us, from what I've been told. So when I look at that and think, is this thing going to collapse from the weight of all this debt? And then I look at the country. The country's got 34 trillion and climbing, a trillion every 6 months or so. And no plan to pay it back, no plan to pay the interest. Impossible. And so there has to be an end game. It doesn't go forever. It does not go to the moon. But as you think about that, how it affects our economy, our way of life, and that sooner or later, I don't mean now or this month or maybe even this year, but sooner or later, at some point, we're going to have a collapse. We're going to have it. It's going to be in the economy and it's going to be in the market. And it may be not just stocks, it may be stocks and bonds. And so when that happens, these sort of things get dealt with. They collapse, they get reset, people default. There's already a lot of unemployment starting to come in, people getting laid off. So I can see just storm clouds out there. You think I'm a negative person. I'm not a negative person. But as I look at this realistically, I have to say, this has to be dealt with. For now, the market kind of seems resilient. We've gotten off to a negative start this year somewhat. But, as I look out, for beyond this year, I don't know. It does not look optimistic. So I would just say to you, as an investor, and if the economy affects your business, plan, be defensive, be prepared for this kind of thing to happen. It hasn't happened for quite a while, maybe 15 years, but we are not immune from it. This is going to happen. So if you believe in cycles. So that's just a scoop. I'm going to play this piece for you. You can take a listen and to CNBC on this question of people's personal finances, debt, and money in the bank.
More than half of Americans with an income of $100,000 a year or higher say they're living paycheck to paycheck. This may be the result of a sneaky behavioral phenomenon called lifestyle creep.
Lifestyle creep is the common pattern of making a little more money and starting to spend a little bit more money. It happens almost automatically.
I think people hold these benchmarks in their mind. If I reach this position or I get this promotion or I make it to this age, then I can live this life, or then I deserve to have these things. And then they kind of go a little crazy or go a little wild on it. And then it becomes like a trade-off. Like they only can enjoy their present happiness and they're not able to save or plan for the future.
There's nothing wrong with wanting nice things. The mental, emotional reason why we want to acquire more is generally rooted in this need for like your perceived value. Like we live in a world where like the nicer car you drive, the higher your perceived value is.
6 out of every 10 people surveyed said that paying for everyday expenses negatively impacted their mental health.
It does take a lot of joy from just life and always being in this scarcity mindset when there isn't necessarily scarcity to fear.
Here's why Americans feel like they're constantly struggling to keep their paycheck, even when they start making more money.
Say you get a new job and you have a little bit of a pay bump. Suddenly there's a little more room in your budget. Maybe you do some small upgrades, like you eat out rather than cook at home, or buy those Taylor Swift tickets, or upgrade your music subscriptions. Anything like that is an example of lifestyle creep. It's just these little upgrades that are very hard to undo financially or even psychologically once you've made them.
A lot of people have this scarcity mindset around money, and they spend so much of their lives saving. And so there can be this point where if you're constantly saving your whole life and then you finally reach this marker of financial success, or you finally reach this big paycheck number, you feel like you finally deserve to enjoy your life.
The idea that people save and they just hit a point where they feel like they deserve it, I fully disagree with that. Most people don't have $1,000 in the bank. Like most people cannot handle a tire blowout, or they're going to put it on credit. There's no financial literacy, no financial education that happens. The average person does not think about lifestyle inflation at all. I think it's something that's not even on the average person's radar.
Okay, last week, Bitcoin came out with, or the SEC, Securities and Exchange Commission, approved the issuance of an ETF, exchange traded fund, for Bitcoin. That was a big deal, anticipated. And so the number of issuers of ETFs, BlackRock being one of them, stand to benefit from that. The consumer and the institutional investor stand to benefit from that. An actual ETF that tracks Bitcoin and other cryptocurrencies. So I'm going to play a piece from Larry Fink, the CEO of BlackRock. Now, I will say this, and being honest with you, is I'm not a fan of BlackRock. I'm not a fan of Larry Fink. But because they are an issuer of an ETF, IBIT, I believe is the name of it, which is an ETF. He had something to say about it, so that's the reason I'm playing him, not because I endorse anything that he does or BlackRock per se. So it looks like they are here to stay, that Bitcoin and other cryptocurrencies, or most of them, are probably here to stay, and that there's a good future in this. But I would say this, Bitcoin and other cryptocurrencies are very volatile, very risky, and they're kind of all over the place. Yes, they've gone up, but I would just say if you buy cryptocurrency, be very careful, know what you're doing. So I'll play this piece from Larry Fink.
It's the first time we've had an opportunity to talk to you about it, which is Bitcoin, the Bitcoin ETF. We're going to be talking to Gary Gensler, the chair of the SEC, who made that decision reluctantly, maybe even begrudgingly, which was announced just 2 days ago, and we talked a lot about yesterday on the broadcast. How big a deal is that for BlackRock? And this was, for you, a big switch as well, because you were a naysayer for a very, very long time.
Yeah, I probably switched. For the first 3 years of thinking about it, I was a naysayer, and about 2 years ago, I switched. And I'm actually, as I said in the last 2 years, I'm a big believer.
Are you a believer personally? Meaning, is the Fink family a Bitcoin buyer or a buyer of this new ETF?
Well, now I could do that. I cannot, I don't want to compete with our clients, so I don't buy single assets. I'll buy mutual funds. I'll buy single ETFs. So I have an opportunity to do that now. But I'm a believer in it because I do believe it is an alternative source for wealth holding. I don't believe it's ever going to be a currency. I believe it's an asset class.
You don't believe it ever becomes a currency?
No, I think we're going to create digital currencies. We're going to use the technology for it. We're going to use the blockchain.
How important is that, though, to then the long-term value proposition
Of Bitcoin?
of Bitcoin? If it's not something that ultimately becomes a currency, if it's simply, we'll call it digital gold, it's an asset of some sort, what does that mean
It means,
in terms of price?
I believe it goes up if the world is more frightened, if people have fearful of geopolitical risk, they're fearful of their own risk. It's no different than what gold represented over thousands of years. It is a asset class that protects you.
Right.
And unlike gold, where we manufacture new gold, we're almost at the ceiling of the amount of Bitcoin that we created.
When you hear somebody like Kathy Wood,
Yes.
who was on our broadcast yesterday, say
Right.
that her base case is that this turns into a $600,000 a Bitcoin valuation, base case, and a million plus in a super optimistic case. Are you anywhere in her realm?
I haven't thought about it. To me, that what we are trying to do is offer an instrument that can store wealth. I think if it gets that even close to that high, gold will represent even a bigger value. And let's be clear, if you think it's digital gold, there's going to be a reference point between gold and Bitcoin.
So next, this caught my attention. Now, if you followed me for quite a while, you know that over the past several years that I'm a fan of Scott Minerd. Scott Minerd was the CIO, Chief Investment Officer, U.S. equity strategist for Guggenheim, and highly regarded on Wall Street, had the highest performance in his fund category among all managers for many, many years. Anyway, he passed away in the last couple of years, and the person right behind him was a woman named Ann Walsh. Now, I'd read about Ann Walsh, and very accomplished, but because Scott Minerd was such a big deal, she was number two. And so when he passed away, then Ann Walsh was promoted to Chief Investment Officer, and she's very successful, very bright, and I like what she has to say. So I saw this piece by her, and because I knew the history, I thought I would play it. She says that she expects this, and this is something that actually makes sense to me. She said, expect the Fed to lower interest rates this year. She's talking about several times, and as soon as March, okay, we're in January, within the next couple of months, she expects the Fed to start lowering interest rates. That, in the last month or so, I would say in December, that was not agreed upon. That's kind of new thinking. What that tells you is this. In order for the Fed to drop interest rates, there has to be trouble. The economy has got to be struggling. So it tells me that if there's going to be three of them, and I'm going to play, another one as well, if there's going to be three of these rate cuts, it tells you that the economy is going to be heading down. And they're going to do the rate cut in order to goose the economy to get it back up, which it probably will. That typically is a response. So plan on a declining market, a declining economy with some stimulus coming from rate cuts. But, so what that says to me as an investor, an investment manager, what it says is we're going to have a rocky ride in 2024. I've read about this before, but this starts to make sense to me as to how this could happen. So anyway, new thinking. So again, if you're relying on thinking from December, from economists and experts, you will now hear this as a different tone. And it's not because she's overly optimistic. I think that's a realistic view if you're looking at the economy through the lens that, it's struggling. So take a listen to Ann Walsh.
Our next guest says that she expects the Fed to begin cutting rates in March. That's in direct contrast to Cleveland Fed President Loretta Mester, who will vote on interest rate decisions this year. Mester said yesterday that March is likely too early for a rate cut. Ann Walsh is the chief investment officer of Guggenheim Partners Asset Management. And first of all, thanks for being here this morning.
Thank you very much for having me.
So yesterday, the CPI came out. It was a little hotter than had been anticipated, and when you look through some of the lines. Today we get PPI, and obviously we're all trying to figure out what the Fed does next. Where do you think we are on track with this economy? What do you think the Fed will do?
So, as was introduced, we do believe that the economy is continuing to slow down. Inflation is also on a disinflationary track. Yes, the CPI print at a headline level came out pretty hot, particularly as regards owner equivalent rent. But if you look through to the component parts of the report, that really still indicates that PCE, core PCE, which is what the Fed really looks at, is still on track to be right around 2%. And I think that's critical. Additionally, what we're seeing evolve in the economy is kind of a bifurcated economy, and that is there's those companies that are doing pretty well, and then there's sections of the economy that are really slowing down significantly. For example, manufacturing has been in a bit of a slowdown, if you not maybe a recession, if even over the last, say, 18 to 22 months. And so as a result, what we're seeing is this sort of bifurcation happening, and the economy is continuing to slow down. We remain in the camp of believing that we are still seeing a recession, although mild. It's always been our expectation that it would be a mild recession. And, I tend to refer to it as a rolling recession. Depending on where you are in the economy is how you're going to feel about the economy. And what's coming next is really commercial real estate, office properties in particular. And so we're still in this sort of evolution, if you will, of slowing parts of the economy down. We think this leads to the Fed being more in line with historical precedent in terms of recessionary environments, where they will be lowering rates, and a little sooner than market participants now believe.
So CNBC's Andrew Sorkin interviews the Pershing Square CEO, Bill Ackman. He's talking about the future of interest rates, cuts or otherwise. Now everybody's talking about cuts because they're seeing the economy is starting to slip. And so he believes that there will be at least 3 cuts this year, and that is a sign of a very weak and a struggling economy, and a declining stock market. But with these cuts, it should, if it's like the past, just the anticipation of the cut should send the market up. So, and the economy may lag the market. But Bill Ackman is very credible, and I thought you would enjoy this piece. It kind of adds on to the piece that I just played from Ann Walsh. So you put these two together, and it provides a good composite view, in my opinion.
I want to just talk briefly, though, about the markets before we get back to the Henry Kravis and plagiarism and free speech and anti-Semitism issues. You just saw that data come across the tape.
Yes.
Where are you in terms of the markets right now and what you think is happening or not happening?
So on the bond markets, I don't know if you remember, I tweeted that at 5%, I thought the 30-year had kind of gone far enough. We actually reversed our position and went, instead of being short the bond market, we went long the 5-year and the 1-year, again, through these sort of asymmetric instruments at that time. Rates have come in a lot. Right. We've kept that position on because we believe rates are going to come in further. I think the data point that came out this morning is sort of confirmatory.
You think there's 3 rate cuts in the offing now? 4? By the way, we had Larry Fink on in the 6 o'clock hour. He actually thought that we may not get those 3 rate cuts. Maybe it's 2.
Yeah, I think he's wrong. I think we have 3, or certainly, remember, 3 rate cuts is 75 basis points off of, call it 5 1/4, 5 1/2. That's not a significant move. 3 rate cuts would be like a 15% reduction in rates. Right now, we're, with inflation, cooling very meaningfully, the real cost of money is very high right now. So I think they're going to have to move early, and I think they're going to have to move.
So what does that mean?
It could certainly do more than 3 cuts.
What does that mean both to equities but to the larger economy as we look? Remember, we're in a presidential election year.
Yeah. So I think it's good for equities as long as they bring rates down fast enough to avoid a meaningful recession.
So for those of you who are optimistic and you want to hear me give optimistic comments about that the market is going to go up, well, I've got a guy for you to listen to. So this is Hugh Johnson being interviewed by Tyler Matheson, And he's talking about the fact and the detail behind why he believes this, that we are entering or have entered into a new bull market, which means he believes that this is probably a sustained market for some period of time. So I won't say I completely agree with that. I think there's some upside coming, but as I said, I believe it's going to be a rocky ride getting there. But anyway, it's another point of view. I thought you'd enjoy listening to it. So listen to Tyler Matheson and Hugh Johnson.
All right, Dom, let's start with the markets. Our next guest is sticking with a new year, new bull market stance and says the biggest risk is a turn higher in inflation next year. Joining us to talk markets, the Fed, inflation, and earnings, Hugh Johnson, Chairman and Chief Economist with Hugh Johnson Economics. And joining us throughout the hour, happy to say, is CNBC contributor Courtney Garcia, Senior Wealth Advisor with Payne Capital Management. Courtney, good to have you with us in studio. Good to see you here on this side of the Hudson for a change.
Yes.
Usually over at NASDAQ. Hugh Johnson, welcome. Good to see you. Happy New Year.
Thank you. Happy New Year to you, Tyler.
You keep doing this, Hugh. You keep doing this year after year after year. I keep trying to catch you. I can't. So you think a new bull market began back in October, and you think it's got legs?
Oh, yeah. It definitely is. Bull markets go. You know, if you look all the way back to 1890, you've got the average bull market being 47 months. And if you look back to the post-war period, post-World War II, you've got essentially 63 months. So we're at let's call it the 2-month mark, maybe 3-month mark. And when you've got bull markets that last that long, on average, this one's got a lot longer to go.
What was the demarcation point that you think set this bull market off and running?
Well, it's a number of things, Tyler. I think the number one thing is the performance of the financial markets generally, not only the decline in interest rates, but the most important thing was the performance of different sectors of the market. You saw the so-called bull market sectors like consumer discretionary, industrials, and technology stocks doing well. And I think the real tip-off, at least for me, was that for a long time, small capitalization stocks were lagging large capitalization stocks, and that all changed. And that changed in October. And I think that's the signal that a new bull market has really begun. There's a lot of other things that tell you that basically when you look at cycles all the way back to 1890, it's starting to shape up as being a very somewhat normal cycle.
So the final piece I want to play is Diana Olick, and she is an expert on housing. And so she's being interviewed to talk about housing and that there is a squeeze still happening with home buyers. They're getting squeezed because of what's happening in many markets. There are some markets different, but in many markets, the prices are still stubbornly high, and in some markets they are rising, and there is a lack of homes, and there is high interest rates, still pretty high. And so she talks about that and what it does to the affordability of housing and why this is a conundrum in the housing market with high interest rates, high prices, and lack of availability, and causing housing to be unaffordable for many. So take a listen to Diana Olick. Thank you.
Mortgage rates have dropped dramatically in the last few weeks after rising for much of the year. But will that be enough to kickstart the housing market in 2024? Diana Olick joins us now with more. Diana, the woman with the answers.
Good morning, Contessa. Look, 2023 may have been the least affordable housing market in history. Record high and rising home prices combined with rising mortgage rates, which don't usually go together, made that happen. Now, through October at least, the typical 2023 home buyer needed to earn an annual income of at least $110,000 if they wanted to spend no more than 30% of their earnings on monthly housing payments for the median-priced home. Now, that's according to Redfin. The median household income is about $75,000. So there you go. Mortgage rates started this year at about 6.5% and rose steadily over 8%, jumping there in October. They have since fallen back sharply and will start next year about where they did this year. So Let's compare a 6% mortgage rate to an 8% mortgage rate. So if you're buying a $400,000 home with 20% down on a 30-year fixed mortgage, at 6%, your monthly payment is $1,918. That's without insurance or property taxes. At 8%, that jumps to $2,348. So a difference of $430 a month or $5,100 a year. Now, lower rates help on the monthly payment, but home prices continue to rise, and the gains are actually getting bigger because the supply of homes for sale is just so low. As of October, prices were up 4.8% year over year, according to S&P Case-Shiller. That's the largest annual gain of this year. Sellers, however, were a little bit more active this fall, but the supply of homes for sale is still about 38% below pre-pandemic levels. So will sellers get off the fence and list this spring if it would still mean likely trading to a higher rate, but just not an 8% rate? Guys, we will find out.
Yeah, I just thought I'd give you a shot. Because this is so unusual. This is a picture from my porch, and you can see the view that I look at, and that's why I like Montana. And during this time of year, a lot of people don't stick around here, so it's a lack of tourists this time of year, but it's beautiful. And I love looking out at this, and especially in the winter. But it's cold, and we've got some snow. And I guess that's what we have to put up with to get this beautiful country. So I add that picture to my dog pen in my entryway, and so it's all good. Thank you for watching. If you have questions or comments, leave them in the comment section below.